Return on equity is a measure of how efficient a company is at generating profits. In order to calculate the value of a company's stock, we need to consider the profitability of that company. It's important to understand that profitability isn't the same as profit. Profitability takes into consideration the amount of capital required to generate that profit. This is known as return on equity. Return on equity is calculated by dividing the amount of profit by the amount of shareholders' equity used, and it's usually presented as a percentage. In its simplest form, it's easy to see that a $1,000 profit from $10,000 worth of shareholders' equity is better than a $1,000 profit being generated from $20,000 of shareholders' equity. MyClimb calculates this return on equity and uses it as part of our valuation of a company and its shares. In our systems, we normalize the profitability to exclude any one-off, non-recurring adjustments to the bottom line and to add back franking credits. That way, our valuation is more appropriate. Once the real profitability of a company has been established, we're in a position to begin to identify what value we should be attributing to that company's stock. By taking advantage of a realistic valuation and comparing it to the current market price, Climb's customers have been able to make solid returns over the long haul whilst minimizing risk. The next video in this series will take a look at how MyClimb factors risk into our valuation process.